So let me start off a little bit. So the idea of fund families, being something to look at is probably, actually don't know for sure, but I'm going to guess it goes back a long time. This is a quick history of the proliferation of mutual funds. They start, look at that. They start in 1924 when State Street investors start its own fund. This is a modern fund. Like if you go back, get Rodenhorst's paper, but going all the way back to Europe in, I don't know, the 12th century or something. I have no idea what, but it's a long time ago. This is sort of the modern US version of this thing. And here are these guys that run it. And it turns out this guy, Stanislaw, is also affiliated with something called Scudder, Stevens, and Clark. So since this worked, what does Stanislaw do? He goes off with Scudder, Stevens, and Clark. Scudder, Stevens, and Clark launched the first no-load fund in 1928. And then Wellington Funds comes along in 1928 and has the first fund to include both stocks and bonds. So you got to think that these guys right around here start thinking, gee, we could have a lot of these things that do a bunch of different things. And I'm going to guess that the first family of funds was probably created right around when Wellington shows up. I actually don't know for sure. I've tried looking this up, on all the usual sources. I can't find the exact date of the first fund family, but so here's my guess. It's about 1928, and there's obvious reasons you would expect families to appear, right? They can share overhead. This is actually not trivial. And these days there's a big fixed cost of government regulations. It costs about $150,000 plus to start up a mutual fund, and if you have a family, you can get that down a bit. And that's been since 1933. And then finally, you can share information, which is what Brown and Hughes' paper focuses on, the sharing of information. Now, let me start off by saying no one had to convince me that mutual fund families are useful in the sense that they share information. My wife has to be at a credit meeting every morning at 8:30 for everybody in her shop, and they're basically a fixed income shop, and they have multiple funds. And so they're always, they're there every morning, and they're always discussing all their credits, sometimes more or less civilly with each other. So it's clear that the complex matters, right? How you run your operation and everything, that all has an effect. All right. Now, we do know a lot of things about families already. We know funds in larger fund families tend to have somewhat higher returns than funds in smaller fund families. There's several papers on this. And we also know that funds in larger families seemingly trade on similar information. This is from the JAR paper. Stock picking skill measures increase in family size. Position changes in line with subsequent earnings revisions increase with family size. So it does look like, that we already have information and data showing that, families matter, right? People within a family behave in some sense similarly already. All right, so linking families with fund performance. So families can give their funds access to centralized research. That's sort of what the JY paper was about. They look at the passage of Reg FD as sort of a critical date in this whole system. And what they say is, well, look, prior to Reg FD, the family would be able to call up one of the sell-side shops and say, we're a really big client. Maybe you'd like to let us in on some of this information right about now. And of course, they would do it. And then Reg FD comes around and they can't do that anymore. And so they lose this valuable source of information that was spreading through the complex that disappears after Reg FD. And they find some evidence around Reg FD that in fact this sort of correlation drops off, which they then attribute to that. Now, of course, a lot of things happened in the same year, so it's the usual problem with one event studies, but this was basically their thesis. And they also, families can offer expertise in a particular area that a fund can borrow if necessary. So, for example, in my wife's shop, there are people who deal with emerging market debt. And so if she has and she deals with interbank loans. So she has an interbank loan, and there's some, part of the whole the bank system that is involved with this that suddenly opens up something in Africa or something. She can go to the people who are doing the emerging market debt and say, ask them about various things about it. So, she grabs people who she needs and people grab her and vice versa. So there are a lot of ways complexes help out their managers. All right, so what about measuring this stuff, right? It's one thing to say we all think it's there, and we have various evidence that it's there. So the question is, how would you measure such a thing? So part one of the paper, and it's really the majority of the paper, examines basically what's essentially a statistical model. It's not really a theoretical model in the way I would normally think about it. There isn't sort of an equilibrium concept in here, in that you don't have funds competing with each other and families competing with each other. We don't have investors who are anything more than automatons, right? They're assigned sort of a way of behaving, and then they just behave that way. It's really a type of Bayesian learning statistical model, which I have nothing wrong with. I think that's perfectly fine. But what it really is, it's a way of looking at the data. And it basically employs a common filter style model when you get done, right? When you look at it, well, how would you do this? You wind up with this common filter model in which fund skills are potentially time varying and return signal the current state of the firm's family, the fund and family skill. Now that's the first part, where fund skills are potentially time varying, is similar to the single fund models I had with Mamaisky and Zhang, where we had time varying information flows. That is, sometimes you knew something and sometimes you didn't, but your skill was a constant. So you could imagine time varying skill is another way of looking at the same thing. So you can take these models and you can actually apply them directly to the data. In this case, though, what they do is they show that investors learn from both the individual funds returns and those produced by other funds in the same family, which we would sort of expect to come out of a statistical model like this. The interesting thing I think that they do find is sort of the size-related things, which aren't quite as intuitive, which is the larger the complex, the faster investors learn about a family's skill level, and investors react by using the family's returns in their flow decisions. So this is all, I think, actually a pretty interesting direct result out of the model. And the impact increases for these things as the fund size gets bigger. So that they do get something out of looking at the statistical simulations that I think you couldn't have guessed ahead of time. But then they get to the actual statistical model, and they run a factor model with monthly returns, calculate the monthly alphas and residuals. Then they run an AR1 model on the estimated alphas, calculate the residuals from the AR1 model, so they have two sets of residuals to work with. And they create these second stage independent variables, which they call rho and lambda. And rho represents the correlation, the idiosyncratic risk among funds in a family. And lambda represents the degree which funds rely on a common factor from the family with which to generate returns. So this is basically from the 4-factor or 3-factor model, and this is the coefficients on the AR1 model that they run on the results. So here's where I kind of think that the paper needs work. The statistical model developed and analyzed on pages 6 to 24 is not used in the actual statistical work. Now, it seems to me that going through all that trouble to develop that really extensive statistical model, which is what it is, it's a nice statistical way of looking at the data, they ought to basically drop the factor model stuff and just apply the statistical model straight in and see what they get. Because then we would find out sort of the value of really looking at this sort of fund family thing, right? If we actually take a statistical model, we say, well, look, let's embed the fund in a fund family and look at it statistically the way you would then analyze it as an investor. Let's see how far we get. And it's not clear that right now the statistical model on pages 6 to 24 was actually needed for the statistical work that then follows. And it's not very much. It's only a few tables. If what they really want to do was do the statistics, basically I think a verbal discussion of what a formal model would look like would have sufficed. Right? So the interesting thing would be to take the statistical model, I think, and then really apply it to the returns that we've seen generated and see how that helps them out. My guess is they'll find what they're looking for if they do that. 5 minutes? All right, so no problem. So table 2 looks at returns So I'm now going to talk briefly about the return data they've got. It's generally in line with the idea that mutual fund families have a common impact on their individual funds. Being in a family increases the cross-fund correlation from the factor return model residuals, and being in a family increases the cross-fund correlation from the AR1 alpha model residuals. So it's not too surprising. That's why I was saying I think if they do apply their model directly to the data, they'll find some of the stuff they're looking for, because the simpler factor model regressions on the residuals all produce the same thing. Table 3 shows and finds that flows are correlated with the usual return. So basically, fund alphas, you do well, you get money. If you're a star fund, which means you have a really good quarter, you do get money. If you're big, you don't get money as easily. If you're old, you don't get money as easily. If you have a lot of expenses, it's harder to drag in money. But they also find flows are correlated with the fund family alpha, so that's something. Again, so this is why I think they'll find what they're looking for. So there is, however, weak support. So they kind of claim it's pretty strong, but I think it's pretty weak for the idea that family size up implies information investors draw from the family's returns also up. That is, as families get bigger, investors get more information from the family returns. They do this by testing this coefficient right here, and then they add an n to it and check how that does. And the thing is, it's significant. Did I write it down which way? I forgot. Okay, here it's coefficient's insignificant in 3-factor, but it's significant in the 4. I got to tell you, tables, papers, I've seen so bloody many numbers. Anytime I see them come out differently, I'm like, okay, that's just data mining, gang. All right, so at least for me, you're not going to convince me by having one factor model be significant and the other insignificant. The other thing I would suggest is including the market return and the regressions that they run for these tests, which they don't have right now. High market returns lead to high mutual fund flows, and that's going to create correlated flows across the funds, right? Because if generally flows are big, everybody's going to get money. And I don't think this will change the results of interest, but it's one of those things that sort of just should be in there. So here's my final suggestion here. I think either drop the statistical model developed on pages 6 to 24 or use it in the actual statistical work. Now, I wouldn't actually recommend dropping this model. They spend a lot of time and effort on it. There's no reason to drop it. It's actually the really good part of the paper because it tells you a little bit about how you might want to think about funds embedded within fund families as opposed to the usual way we run our statistical models on mutual funds, which is sort of fund at a time. So I think it's a good idea. They should just drop the 3 tables they got now and replace it with the tables this would generate, is kind of the way I would suggest doing things. Because right now, as things stand, the statistical model itself is not really a theoretical contribution. It's not really an equilibrium model. And the statistical model, the statistical work is itself not very much. So I think if they just do this one thing, I think they have a perfectly fine paper and potentially have a lot of interest because I think there's a lot of interest in fund families. We see papers coming out on this topic, and to get a better idea of how to use that data to sort of look at the way returns function over time would be really nice. So anyway, I'm going to quit here.